legal, as well as on the trading floor, in derivative structuring, corporate strategy, and finally landed after working at law firms and investment banks for many years at ICMA in 2013. Since then, I have served as the head of Asia for the association, covering the Asia-Pacific region. Research actually showed that the Asian international bond market issuance has gone 6 times more than it was 15 years ago. So from about 100 billion annual issuance to more than 600 billion. The easiest answer is one word: China. So Chinese issuance has gone from basically zero to almost 40% of international bond issuance over the last couple of years, although that has fallen off a little bit due to recent developments. There are a couple of other major reasons, though. I think one important reason is that issuers have changed. So issuers in Asia have both gotten more sophisticated, but also their operations have become more international, and they find it more useful to actually raise funds in foreign currencies and in international currencies than they have in previous years. Secondly, I think that investor behavior has changed. So international investors have become much more interested in emerging market credits. That's one, so the demand has increased. But also, if we look at the macro environment over the last few years, the rate differential between more developed countries, where rates had historically been quite low, and emerging markets such as Asia, where rates have been a little bit better, that's also a very pure incentive to fuel demand into Asia and give incentives to issuers to raise funds offshore. Very diligently, very carefully, and spending a lot of time. Let me put it that way. So at ICMA, the way we work is we convene committees of market participants, and we get together and debate and discuss how to improve common practices in deal execution, in documentation, in compliance with existing regulations. So what we do is always consistent with the existing law or regulations, but when there is actually room, when there's freedom for the market to act in different ways and to do deals in different ways, sometimes it's actually very helpful to have common standards, have common ways of going about things. So proprietary orders and book updates are 2 examples of this. Historically, proprietary orders had been treated in a very confusing way, and there wasn't much guidance from regulators on this. And similarly with book disclosure, it had been quite inconsistent from deal to deal and different kinds of transactions. Now, of course, what we've seen is the new reforms from the Hong Kong Securities and Futures Commission on book building and placing, not only in ECM markets, which we don't cover as much, but in DCM markets and bond markets, which is ICMA's focus. So this is a very significant regulation, and we have spent enormous amounts of time and effort working with our member banks, working with our member investors, working with our member private banks, and also working with the SEC to come up with good interpretations of the new code and actual explicit, detailed ways of handling proprietary orders and giving book updates to the market in a way that's fair and efficient to everyone. Now, our work is still not over yet. I think we're still grappling with some operational and compliance questions about how to handle proprietary orders, how they should be treated in terms of allocations, how to deal with issuer preferences, how to deal with record keeping, how to disclose proprietary orders to the market in the book building process. What definition should be used for proprietary orders, whether it's a more commonsensical, traditional definition or a more kind of legalistic, regulatory definition of proprietary orders. And then at what points in the deal do we give book updates to investors? What level of detail should we offer in those book updates? And what should the timing of those book updates be in the context of very quick dynamics of DCM book building? So these are very difficult questions, and we are in endless discussions, frankly, to get it right. But I think we've made some excellent progress, and I feel proud at ICMA that we've been able to convene a forum and really help the market to hash out these questions in a logical and kind of fair way outside of the mayhem of actual deal execution. Of course, we see sustainable finance growing exponentially, and it's not just the growth in issuance, but it's also just the fact that it's become mainstream. It's embedded in all issuance and all actions in the financial markets nowadays. So it's extremely important. And the way I personally look at the intersection between fintech and sustainability is looking at sustainability data throughout the entire quote-unquote life cycle. So what do I mean by that? So when you look at sustainable data, it starts from very raw data, raw corporate data. So emissions, for example. And we're seeing solutions for that. We're seeing Internet of Things. We're seeing very kind of tangible technologies for gathering that raw data that is eventually going to be used by regulators and investors. There are technological solutions already being placed there for corporate issuers. Then once the corporates have the data, the raw data, the next step is how do you process that data for outward disclosure? How do you structure that data? How do you put it together efficiently? You have different stakeholders, you have different people, you have different organizations that you need to give that information to, different kinds of information, different levels of detail. And this is a lot of work, and it can get very complicated. So there are a number of actual fintech solutions to help with that and to make that data more efficiently organized and more easy and quicker to disseminate. That's extremely important. Then in sustainable finance, another application of fintech that we're seeing growing is creating marketplaces. So this is basically electronic trading in sustainable finance, and we're seeing blockchain solutions here. We're seeing other kind of basically electronic trading systems and information systems to bring together investors and issuers in order to basically increase supply and increase demand and increase efficiency in trading. And then one more step is that once the investors actually have the sustainable finance instruments, they have to analyze the sustainability data, they have to analyze the sustainability risk, the climate risk associated with that. They have to analyze these instruments on a portfolio level from a risk, return perspective, and from a sustainability perspective as well. And again, there are fintech tools for that are very interesting. Some of them are very sectoral specific, such as looking at flood risk for real estate. Some of them are much more general in nature, looking at very broad climate risk in conjunction with some of the science-based models out there. And then last but not least, one more step is actually looking at it from a regulatory point of view. And we're now seeing, it's quite nascent, but we're starting to see things like AI solutions for looking at disclosure, looking how that's changed over time, analyzing that for sustainability and climate risks. So really a number of different fintech applications that are making sustainable finance more useful, more efficient, and more relevant for everyone involved. Major changes are going to be a product of the enormous macro shift that we're seeing, which is the interest rate environment. So this is having knock-on effects in many ways, and some in very micro ways. And so overall, what we've seen is that the markets have softened. Things are going to be a little bit more challenging for issuers in Asia, certainly not just the uncertainty, but also the cost of funding. And so what is this going to mean? Right? It's going to mean that there are going to be increased refinancing risk for issuers. There's going to be increased credit risk for investors. And we may see shifts in the types of funding that issuers go for. So we've already been seeing, for example, some issuers are looking more towards the loan markets, looking more towards the local markets, and maybe shifting a little bit away from international markets. I'm not saying that's going to be a permanent trend, but that is going to certainly be a factor. I think issuers are going to be looking at different kinds of funding and different structures, whereas they may have just been comfortable carrying on in the normal course in the international bond markets. Now, because of the demand-supply dynamic, because of the increased potential credit risk and financing risk. I think that could also create new potential changes in documentation. Now, I'm going out on a limb here, but I think that there may be more robust language in favor of investors in terms of covenants, in terms of restructuring, and so forth. So the balance may shift in this respect. And we may see, of course, some of these documents being tested due to emerging market credit risks. We've already seen it with Sri Lanka, for example. This is causing, a rethink of sovereign bond documentation, of sovereign bond restructuring procedures. And so I think in terms of kind of operation and the legal frameworks of fixed income instruments, particularly in Asia and EM, there may be some changes coming through in the medium term due to the overall macro effects. Knowledge of the folks I meet at this conference is phenomenal. I feel like everyone's 3 times smarter than I am, and quite often I realize 2 years after a conference, I've been to this conference for several years, that the conversation I had 18 months ago or 24 months ago was quite prescient, and that they were right and I was wrong about where the fixed income market is going. So I find that the conference is extremely valuable for me to ask all the dumb questions that I'm afraid to ask in more formal settings. People are very friendly and indulgent with me.